This is an overview of the brief exercises from Chapter 7. So we are going to start with brief exercise 7-3. The following data was gathered to use to reconcile Red and Company. The balance per the bank, 25,750. Balance per company records, 19,140. Bank service charge, 45. Deposits in transit, 2,300. Notes collected by the bank with interest, $200 interest, 5,200. And outstanding checks, 3,755. What is the adjusted balance on the bank reconciliation? Journalize any entries necessary for Redden to balance based on the bank rec. Okay, so we're going to start here and it's going to say bank reconciliation. I'm going to make this bold. Okay, so we're going to start with balance per bank. So according to this, the balance per the bank was 25,750. Just going to make this in dollars. We're going to add plus deposits in transit. So this is a deposit that the bank hasn't put in or hasn't cleared, but we have recorded it on the company's balance, 19,400. We're going to subtract outstanding checks. These are checks we've written that haven't been cashed or cleared the bank. So minus 3,755. And we're going to get adjusted balance. And I'm going to sum this all up. So my adjusted balance, deposits in transit was 2,300. So our adjusted balance, should say adjusted balance, is 24,295. So now we're going to do balance per company. This is 19,140. And we are going to do plus note collected So the note collected by the bank, including interest, is $5,200. That means the bank collected a notes receivable for us and charged the interest. And then we're going to subtract bank service charge minus $45. So we should get adjusted balance. We're going to sum this all up. So when we're done, the adjusted balance should match per the company and per the bank. Now, we're going to make journal entries for anything that we had to do to the company, not the bank. So our journal entries is first to record the note receivable, right? So we received cash, 5,200, because it was a positive to cash. That's our debit. And it's note receivable, and then interest revenue. So if they said they collected $200, just make this $200 in interest. So the note receivable was 5,200 minus the 200 in interest. So we collected 5,000 on a note, and interest revenue is 200. Now, for the bank, we get miscellaneous expense or bank fees, and that was $45. So we're debiting the expense, we're crediting cash because that's a negative to cash. And those are the journal entries. So this is a bank reconciliation, and we got to an adjusted balance that matched with the bank and the company records, and then we made journal entries. So we're going to move on to exercise 7-4. Exercise 7-4 is about petty cash. So it says you issued a check to establish a petty cash fund of $500. The amount of the petty cash fund is $85. You issued a check to replenish it based on the summary of the following receipts: store supplies, miscellaneous, selling expenses. Record any missing to cash, short, and over. All right, so let me do this. We got journal entries. So the first journal entry that we're going to do is we're going to debit petty cash, $500. We're going to credit cash. So we wrote a check out of the bank account to the petty cash. We took the cash out. We create the petty cash fund. Then the second entry, we're going to do store supplies, 360. Then we do miscellaneous selling expenses, 40. So we need to figure out what the cash, short, and over is. So cash, so how we're going to come up with this equals the $500 in petty cash minus the $85 that we have left, because it says we have 85 left. So all I did was equals $500 in petty cash minus 85 that we have left. So in order for this journal entry to balance, we're going to have cash, short, and over, and that's 415 minus 360 minus 40. So there was a $15 that we didn't get a receipt for. And that's the journal entry number 2. The final journal entry on brief exercises, this is not journal entries, this is a calculation. So it says on the financial statements, the data for year December 31st company is determined as follows. This is the cash on hand, calculate cash on hand. Determine cash on hand days. Okay. So they give us the cash, short-term investments, operating expenses, and depreciation for 20Y9 and 20Y8. So the calculation for days cash on hand equals cash plus short-term investments divided by the parentheses, remember orders of operation, right? Divided by operating expenses. So how long minus depreciation expense divided by 365. So what we're trying to calculate is if we're operating, how many days can we operate if we take in no more cash, right? So we have cash end of year. So we're going to take this information from above. So in 20Y9 and 20Y8. Then we need short-term investments. All I'm doing is copying the data from above for each year. And then we need to have a total. So we're going to total these. Okay. Pretty close to each other. And then we have operating expenses. And then we have less depreciation expense. So I'm going to put it in a negative. And then we have total. We're going to add these two up. Okay. Days cash on hand equals this, divided by this, divided by 365. So if we're going to round to the nearest day, round to 1 decimal is what it says. So again, the formula is total from above, so the cash and short-term investments, divided by total operating after depreciation, divided by 365. So they have 262.8 days cash on hand in 20Y9 and 234.9 days in 20Y8. So they have increased their cash on hand from 20Y8 to 20Y9. And that's the example of the 3 brief exercises, and you will do similar ones in Cengage for homework.